Good morning. Welcome to the Brew. I am Lex, your host. Today, we're talking with Paulina about how bonds are impacting the financial markets and the economy. A lot of talk around that, a lot of activity. So let's get right to it with Paulina. Good morning, Paulina. How are you?
Good morning, Lex. I'm doing great. How are you?
I'm doing great. What do you notice that's different about the show today? Obvious, no Molly, right?
Yeah, just the
Molly,
two of us today.
just the two of us. We've done this before, just the two of us. That's when I first met you, by the way.
Yeah,
Was
how about that?
a long time ago. We did a show on Options Brew TV together, which I loved. So that's how we got to know each other. Yeah, that was great. So we're going to do that today, except we're going to talk about bonds today, right? So,
Yep.
as I said, how they're impacting the financial markets and the economy. So I'm going to let you explain it, but obviously bond yields have been rising, right? In this environment. So let's get into it. We have some questions. I'll let you explain, just lay it up for us. What's going on here?
Yes, so the 10-year US Treasury yield crossed 5% recently, and that's the highest level in the past 16 years. So people are really paying attention to this. And this obviously comes after decades of near zero interest rates that we've been experiencing. That ended last year in 2022 when the Fed started increasing interest rates to tame
Mhm.
inflation. And when bond yields rise, especially at such a rapid pace that they've been rising,
Mhm.
this impacts the stock market and the economy. And that's what I wanted to talk about today.
Okay, excellent. So first thing, two things are happening here. Not just the fact that interest rates are rising is one, but the speed at which they're rising is also profound, right? I haven't seen anything like this, like you said, in 16 years. It's about the time, right? It's been a long time. So both of these, the fact that they're just going higher and the speed at which they're going higher, is very prominent. So why is that happening? What's going on here?
Yeah, so let's take a look at the background. So I think the conversation here is going to be centered around the 10-year. So the
Mhm.
10-year Treasury yield, that's considered a really important economic benchmark because it affects rates on things like mortgages,
Mhm.
student loans, and credit cards. So as we said, that crossed 5% recently.
Mhm.
And in effect, that made the 30-year fixed rate mortgage hit 8% for the first time since the year 2000.
Wow.
And, and just to give you some context, that takes the average monthly payment on a US home to more than $3,000. And that's even before paying taxes and fees.
Right.
And for additional context there, the average loan interest rate for someone with a pretty good credit score, let's say 720,
Mhm.
that's almost 11.5%. And
Wow.
that's why we've been seeing credit card debt settle at all-time highs. I'm sure you know this. It topped $1 trillion for the first time this summer
Mhm.
because that's how people are funding their everyday purchases nowadays. But because of the 10-year and overall interest rates increasing, the cost of borrowing and paying down debt has gotten significantly expensive.
Mhm, mhm. Yeah, so, you mentioned that the 10 year is such a good benchmark because it affects mortgages, credit card, student loans, mortgages especially. Let's take a peek there real quick. Um, the it still seems like the housing market is still pretty solid though, and that's my confusion, is that even with this rising interest rate, I at least where I'm living, I'm seeing a lot of turnover. Am I missing something here, or is it just like it's gonna tail here sooner than later?
Well, I think we're seeing that because there has been a historic low supply of homes,
Mm,
and that has been pushing the price of homes up. But with interest rates at the level at they're at, that's kind of been taming the housing market and kind of settling home prices
mhm,
at a certain level. So, but I think over the long term, near long term, we're going to have an issue of supply within the housing market. So
mhm.
that's something that will pay attention to. And I believe the Federal Reserve and their interest rate dynamics are directly impacting that.
Yeah. So I mean, are you in the camp that we're still going to have more rate hikes, or you think we're pretty done with that? I can't tell. I don't know what camp I'm in. I think we're getting toward the end of it, but I think you mentioned on a previous show, the inflation, we're trying to get to 2%. That's the goal. We got a long way to go, right?
Well, we do have a long way to go. The Federal Reserve has been using interest rates as its main tool to bring inflation down to its 2% target, but inflation is really sticky. And while the Fed has made progress over the last year, there's still a long way to go. And that's what Fed Chair Jerome Powell has been saying. There are two FOMC meetings before the end of the year, one this week, and then another one on December 13th. That is going to give us an idea of where the Fed is going to be taking interest rates. There might be one more hike left this year, but there also might be one in the beginning of next year. So we're still waiting to see what happens there. The stock market is paying attention to that, and of course consumers are paying attention to it as well, because it directly impacts how they participate in the economy.
Sure. So, my next question is going to be, how does this impact the stock market? And I'll give you a little, part of the layup part of this is that I was speaking to a financial planner a couple of weeks ago, and, you start getting 10 years to the 5% level, all of a sudden, people are going to be like, wait a minute, I can make 5% guaranteed by the US government versus taking a riskier chance in the markets. Why wouldn't I switch my money from the stock market to these higher, it's 10-year kind of treasury? Is there any logic in that, or what am I missing?
Yeah, that's exactly the logic that people are following. So
Okay.
the S&P 500, the S&P is up 7% year to date. So that doesn't really scream too much of a concern here.
Sure.
But over the past quarter, it's actually down 4%. So how did we get to this kind of negativity?
Hmm.
Because the economy, we just got the third quarter GDP reading at 4.9%.
Hmm.
That's growing year over year, and that was followed by a sell-off in the stock market, and that dragged the S&P more than 10% below its recent peak, actually pulling it down to correction territory.
Hmm.
So this negativity kind of takes us back to the 10-year again. Its yield is at its highest since 2007, and it points to the exact point that you just said. It's important because the 10-year is a low risk investment that's paying investors a healthy 5% yield.
Hmm.
That's in direct competition to stocks. And the thinking is just as you laid it out. Why should I take more risk by investing in stocks when I can invest in low risk assets like bonds and get a guaranteed return?
Hmm.
Obviously, the risk trade off comes with a lower reward with bonds, but they become more attractive to investors, and are increasingly seen as an alternative to stocks.
Got
So
it.
that's the dynamic that's at play here.
Yeah. I mean, my feeling is I'm trying to think through this a little bit, from being invested in stocks, let's say. If I had new money to add to the equation, my investment horizon, I think my strategy would be to put it in some sort of 10-year sort of treasury, as opposed to investing in stocks at this point, because of what we just talked about. It's
Mhm.
at a point where it's too much. The treasuries are too much of a yield to overlook them, I think. Right.
I agree. I agree, and that's what investors are thinking as well. In the near term, there are so many uncertainties in the market, but also in the global economy. We have
Hmm.
geopolitical conflict.
Sure.
We have tensions with the U.S. and China. China is such a key market for U.S. companies. There are so many U.S. multinational companies that do business abroad that see China as their growth market, and that has been really impacted by the political tensions that are going on between US and China. So there are many challenges. Of course, we can't forget the war that's going on in
Hmm.
Ukraine and Russia. Of course, the war in the Middle East as well. So
Hmm.
there's a lot of uncertainty out there. So with so much uncertainty, investors might logically point to allocating more towards bonds, which provide a guaranteed return versus something risky like stocks.
Hmm.
Um, so that's exactly what's happening.
Yeah, no, it makes sense. Is there a bigger impact with higher yields on tech stocks, versus just the general stock market at large? Do tech stocks tend to have more of a challenge in higher interest rate environments? And they tend to borrow a lot of money, right? These tech companies, don't they?
Exactly. And that's exactly why higher yields are usually bad news for tech stocks because it makes their future cash flows less valuable.
Hmm.
So investors, they buy into tech stocks for the promise of their massive future profits.
Hmm.
But as rates have been elevated, the present value of those future profits is worth less
Hmm.
because investors can find better ways to invest their money in the near term, like going into bonds.
Right.
And we've already seen huge market gains from a select few of tech names that have been carrying the market. And we've talked about them, of course, Amazon, Meta Platforms, Nvidia.
Hmm.
These big leaders have been leading the charge in artificial intelligence, but they've recently seen a pullback. So investors that have been relying on big tech for growth, they've incurred massive losses because of the recent pullback in these
Right.
magnificent seven stocks.
Hmm.
So if the Fed continues to tighten and bond yields continue to go even higher, that's going to continue to be a headwind for these tech
Yeah.
stocks.
Do you have, I know you're not an investment advisor, so I want to say that first, but do you have a personal opinion on where this levels out these 10 years? I mean, does this get to 7%? I mean, I'm thinking to myself, it could. I mean, there's a possibility here. I mean, not in a week or anything, but I'm talking about as we progress here. It's kind of scary in a way. I don't know.
It's a challenge, and there are so many different dynamics at play. I think if it really depends on where the Federal Reserve is going to be taking its monetary policy.
Yeah.
If there's a change in interest rates, then we might see the 10-year kind of divert from where it's been.
Hmm.
But I think if the Fed continues its interest rate hiking cycle, there is a possibility of the 10-year going even higher.
Hmm.
And that's of course going to have implications to the stock market. A lot of analysts are actually adjusting their
Hmm.
end of year targets for how the stock market is going to perform based off of how the 10-year has been performing. So it certainly can go higher, but I think we have to look at the Fed as a benchmark as to where things may go from here.
Yeah. Okay. Yeah, I mean, yeah, and it depends on how old you are, I guess, right? For your investment strategy. So the older you get, you tend to be, pushing toward 50%, stock market, 50% bonds, I guess, or safer investments. I could certainly see a little bit of swinging the other way, like 60 bonds, 40 stock now. I mean, this is insane. Every time I win the
Yeah.
lotto,
Mhm.
right? I calculate my lotto winnings of how much I'm going to earn a year. I always calculate 0.05375, 5 3/8%. And I was as a joke, and now it's legit. I mean, you could actually get that now. Crazy, right?
It is crazy. And it always makes you question the traditional 60-40 portfolio principle, 60% stocks, 40% bonds. Um, and I think that is an evolving principle based off of what's been happening in the world today.
Yeah.
Uh, I don't believe that you should take a one size fits all approach anymore because things are so dynamic and everyone has their own individual challenges. And I think with technology, that has given us the ability to further personalize our investment strategy. So
Mhm.
I
Yeah.
think that's something for people to consider.
All right. Well, we're going to stay tuned to this. I'm going to keep an eye on this one, with all this going on this night. Although we had a pretty good day last Tuesday I'm sorry, Monday of this week when we first started. Big up day. on Monday. So that was kind of fun, but we'll see. Great to see you as always. Thanks for coming on. Stay with us as we go to the close. I know Max is gonna cut us off here, but I'll talk to you next Friday. Okay. Have a great
Sounds
weekend.
great. You
Okay,
too.
Paulina. Bye now.